there exists a pattern in the history of capital that most investors never notice until it is too late. 5 times in the last century, markets have collapsed in ways that seem to defy all logic and preparation. The Great Depression of 1929 saw stock prices disintegrate by 89%, erasing fortunes that families had built over generations. The stagflation of the 1970s brought a phenomenon economists had declared impossible, where rising prices and economic stagnation occurred simultaneously, destroying the value of bonds and savings accounts that were supposed to be safe havens. The financial crisis of 2008 wiped out $10 trillion in wealth as the global banking system teetered on the edge of complete collapse. The COVID pandemic in 2020 triggered a market crash of 35% in just 3 weeks, a speed of destruction that rivaled the most catastrophic days of the Depression era. Then came 2022, when growth stocks that had been the darlings of the previous decade fell by 70%, leaving portfolios decimated even as the broader market seemed to stabilize. These 5 crises shared almost nothing in common in terms of their causes, their mechanisms, or their immediate effects on different asset classes. Yet there is something deeply unsettling about the current moment that connects it to all of these historical episodes. This is the largest cash position he has ever maintained in the history of his firm. He has sold half of his stake in Apple, the company he once called the best business in the world. He is not buying anything of significance, despite sitting on more deployable capital than almost any entity on Earth. Meanwhile, central banks around the world are purchasing physical gold at a rate not seen in 70 years, accumulating over 1,000 tons annually for 3 consecutive years. China has officially increased its reserves from 1,000 tons to over 2,000 tons, though experts believe the true figure may be significantly higher given unreported purchases. Russia liquidated its holdings of U.S. Treasury securities and converted the proceeds into gold. Poland has doubled its gold reserves. Turkey, India, and Singapore are all quietly accumulating. These are not the actions of institutions preparing for continued prosperity. These are the preparations of those who see something coming. To understand what they see, we must travel back to a moment when the world last believed that prosperity was permanent, and that the old rules of boom and bust had been transcended. In the autumn of 1929, the American stock market had reached heights that seemed to validate a new era of endless growth. Industrial production was soaring. Consumer goods that had once been luxuries were becoming commonplace in middle-class households. The ticker-tape machines that relayed stock prices to brokerage offices across the nation showed almost nothing but gains, day after day, month after month. Ordinary citizens were borrowing money to buy stocks on margin, convinced that prices would only continue to rise. Then came October, and the world learned a lesson it would forget and relearn several more times over the coming century. On October 24th, panic selling began. By October 29th, Black Tuesday, the collapse was in full force. But this was only the beginning. The market would continue to fall, not for weeks or months, but for nearly 3 years. By the summer of 1932, stocks had lost 89% of their value from the peak. Companies that had seemed invincible were bankrupt. Banks that had stood for generations closed their doors, taking the life savings of millions with them. Unemployment reached 25%. Bread lines stretched for blocks in cities across America. The Dust Bowl turned vast stretches of farmland into wasteland, driving families from their homes in desperate migrations westward. Yet in the midst of this devastation, a small number of individuals not only survived, but positioned themselves to accumulate tremendous wealth in the years that followed. Bernard Baruch was one such figure, a financier who had made and lost fortunes in previous market cycles and understood something that most of his contemporaries did not. While others remained fully invested, believing that the market would recover quickly, as it had after previous panics, Baruch moved heavily into cash before the crash. As the depression deepened and prices fell by 25% due to deflation, that cash gained purchasing power automatically. When Treasury bills paid 3 to 4% interest during this period of falling prices, the real return was 28 to 30%. Baruch waited patiently, while others were forced to sell assets at any price to meet margin calls or simply to survive. Then, in 1932 and 1933, as prices reached their absolute lows and despair was at its peak, he deployed that capital systematically. By 1936, he had not only recovered his previous wealth, but had grown substantially wealthier than he had been at the peak of the boom. The lesson of the Depression seemed to be that cash, and the optionality it provided, was the ultimate insurance against catastrophic deflation. But the world is rarely generous enough to teach only one lesson. 4 decades later, a new crisis emerged that would have destroyed anyone who had learned only the lesson of 1929. The 1970s brought stagflation, a combination of stagnant economic growth and rising inflation that the dominant economic theories of the time said could not exist. The oil shocks of 1973 and 1979 sent energy prices soaring. The decision by President Nixon to abandon the gold standard in 1971 severed the last link between the dollar and any tangible commodity, allowing the money supply to expand in ways that had been previously constrained. Inflation rose from roughly 3% in 1970 to over 13% by 1980. For those holding cash, this was catastrophic. The purchasing power of $1 in 1980 was less than half what it had been in 1970. Bonds, long considered the safest investment for conservative investors, were devastated as rising interest rates caused their prices to plummet. Savings accounts offered interest rates that were consistently below the rate of inflation, meaning that savers were losing money in real terms year after year. The stock market, measured in nominal terms, went essentially nowhere from 1968 to 1982. A period of 14 years during which an investor would have made no progress at all if measured purely by price appreciation. Yet there was one asset that thrived during this period when almost everything else was failing. Gold, which had been fixed at $35 per ounce when the link to the dollar was severed, began a climb that would take it to $850 by 1980, a 24-fold increase in a single decade. Those who held physical gold not only preserved their wealth, but multiplied it many times over, while the purchasing power of paper assets disintegrated. The 1970s taught a lesson that was the mirror image of the Depression. That in times of currency, debasement and inflation, the oldest form of money known to humanity would reassert its value. But the lessons of history are never as simple as a binary choice between two alternatives. The next great crisis would demonstrate that even the assets that had proven themselves in previous catastrophes could face moments of severe testing before ultimately validating their protective qualities. The financial crisis of 2008 began with the collapse of the subprime mortgage market, but quickly metastasized into a systemic crisis that threatened the entire global banking system. Lehman Brothers, one of the most prestigious investment banks on Wall Street, declared bankruptcy in September 2008. Bear Stearns had been absorbed by JP Morgan in a fire sale months earlier. AIG, an insurance giant that had been considered unshakable, required a government bailout of over $100 billion. The stock market fell 57% from its peak in October 2007 to its trough in March 2009. But what made this crisis particularly instructive was the way different asset classes behaved in its various phases. Initially, there was a flight to safety that saw even gold prices fall from $850 to $700 as investors liquidated everything to raise cash and meet margin calls. Cash was king in those terrifying weeks when no one knew which major financial institution would be the next to fail. Then came the response from central banks, led by the Federal Reserve under Chairman Ben Bernanke. The Fed lowered interest rates to effectively zero and began a program of quantitative easing, purchasing government bonds and mortgage-backed securities on a scale never before attempted in American history. Over the course of the crisis and its aftermath, the Fed's balance sheet expanded by roughly $1.5 trillion as newly created money flooded into the financial system. This massive injection of liquidity had profound effects on asset prices. Gold, which had fallen to $700 in the initial panic, began a climb that took it to $1,200 by 2009 and $1,900 by 2011, more than doubling from its crisis lows. The stock market, which had seemed like it might never recover, began a bull run that would last over a decade and see the S&P 500 return 400% from its March 2009 low to the beginning of 2020. Warren Buffett's behavior during this crisis offers a masterclass in the power of maintaining optionality through cash reserves. Berkshire Hathaway entered the crisis holding approximately $40 billion in cash and short-term Treasury securities. As panic reached its peak and even blue-chip companies found themselves unable to access capital markets at reasonable rates, Buffett deployed billions in highly favorable deals. He invested $5 billion in Goldman Sachs in September 2008, receiving preferred shares that paid a 10% dividend and warrants that would prove enormously valuable as the stock recovered. He made a similar $3 billion investment in General Electric. Later, he would invest $5 billion in Bank of America under similarly favorable terms. These investments, made possible only because Berkshire had maintained huge cash reserves during the preceding boom years, generated tens of billions in returns as the crisis passed and normal market conditions returned. Buffett had not tried to time the exact bottom of the market. He had not predicted the precise mechanism of the crisis. He had simply maintained optionality, waiting for the moment when fear was at its peak and capital was most valuable, then deployed at prices and terms that would have been impossible to obtain in normal times. The years following the 2008 crisis reinforced a pattern that had been visible in previous recoveries, but that most investors still failed to internalize. The S&P 500, despite having fallen by more than half, recovered all of its losses by March 2013, just 4 years after the bottom. An investor who had put $100,000 into an S&P 500 index fund at the March 2009 low would have seen that investment grow to $500,000 by early 2020 May, a 5-fold return in roughly 11 years. Even those who had bought at the peak in 2007 and held through the entire crisis would have been made whole by 2013 and would have seen substantial gains in the years that followed. The companies that composed the index, America's 500 largest corporations, continued to generate earnings and adapt to changing conditions. Some failed and were replaced, but the index itself proved anti-fragile, emerging stronger from each crisis. Then came a crisis that seemed to emerge from nowhere, following a script that no economic model had predicted. In early 2020, a virus that had appeared in Wuhan, China, began to spread globally. By March, it had become clear that this was not a localized outbreak, but a pandemic that would force governments around the world to take measures that had not been seen in peacetime in modern history. Economies were essentially shut down. People were ordered to remain in their homes, businesses closed, many never to reopen. Airlines grounded their fleets. The stock market, which had been near all-time highs in February, fell 35% in just 23 days, from 3,400 on the S&P 500 to 2,200. The speed and severity of the decline rivaled anything seen during the Great Depression. Yet this crisis also demonstrated the enduring value of the 3 positions that had survived every previous catastrophe. Cash provided optionality at a moment when fear was absolute. Bill Ackman, a hedge fund manager who had been criticized for his performance in previous years, had positioned his portfolio conservatively and held significant cash reserves. As the market began to fall, he purchased $27 million worth of credit default swaps, essentially insurance policies that would pay out if corporate debt defaults increased. Those swaps, bought at what proved to be the perfect moment, paid out $2.6 billion, nearly a 100-fold return in a matter of weeks. Ackman immediately deployed that capital into companies that had been beaten down far below their fundamental value. He bought stakes in Starbucks, Hilton, and Lowe's at discounts of 40 to 50% from their recent highs. Those positions doubled in value within 4 months as the market recognized that the pandemic, while severe, would not lead to a complete economic collapse. Gold, meanwhile, demonstrated once again its role as a hedge against currency debasement. After falling from $1,550 to $1,450 in the initial March panic as investors sold everything for cash, it recovered quickly as central banks around the world announced stimulus measures that dwarfed even the response to 2008. The Federal Reserve expanded its balance sheet by $4 trillion in a matter of months. Congress passed stimulus bills totaling trillions more. Gold climbed to $2070 by August 2020, a 42% gain in just 5 months from the March lows. The stock market recovery was even more dramatic. The S&P 500 regained all of its losses by August, just 6 months after the bottom. By December 2021, it had reached 4,800, essentially doubling from the March 2020 lows in less than 2 years. Companies adapted with remarkable speed. Technology firms that enabled remote work saw their valuations soar. Retailers shifted to e-commerce. The earnings power of American corporations, in aggregate, proved resilient even in the face of a global pandemic. Those who had sold in panic in March 2020 missed one of the most powerful rallies in market history. Those who had held their index fund positions through the terror not only recovered, but thrived. But the story did not end with the recovery from COVID. The massive stimulus that had been necessary to prevent a complete economic collapse during the lockdowns had consequences that would manifest in the following years. Inflation, which had been dormant for decades, returned with a force that shocked economists and policymakers. By 2022, consumer prices were rising at rates not seen since the early 1980s. The Federal Reserve, which had kept interest rates near zero and continued to expand its balance sheet well into 2021, was forced to reverse course dramatically. Interest rates were raised from near zero to over 5% in the span of roughly 18 months, one of the fastest tightening cycles in the Fed's history. This had predictable effects on asset prices. Growth stocks, particularly in technology, which had soared during the pandemic as investors anticipated a future of remote work and digital transformation, collapsed. Companies that had been valued based on earnings expected years in the future saw their stock prices fall by 70% or more as higher interest rates made those distant cash flows worth less in present value terms. The overall stock market, measured by the S&P 500, fell 18% in 2022. Yet once again, the 3 positions that had survived every previous crisis demonstrated their value. Treasury bills, which had yielded essentially nothing for over a decade, suddenly offered returns of 5% with no risk. An investor who held cash and short-term treasuries not only earned 5%, but did so while the stock market was falling 18%, a relative outperformance of 23 percentage points. Gold, while volatile, maintained its value as a hedge against the long-term consequences of the monetary expansion that had occurred. And the S&P 500, despite falling 18% in 2022, rose 25% in 2023, once again rewarding those who held through the turbulence rather than selling in fear. The pattern that emerges from examining these 5 crises spanning nearly a century is both simple and profound. Cash and short-term treasury securities provide optionality and purchasing power in deflationary crises and moments of panic. Physical gold protects against inflation and currency debasement when governments respond to crises by expanding the money supply. An index fund of large American corporations provides long-term growth and has recovered from every decline in history given sufficient time. No single one of these positions is sufficient. Cash would have been devastated by the inflation of the 1970s. Gold provides no income and can be volatile in the short term. Stocks can fall by 50% or more and take years to recover. But held together, in proportions appropriate to one's time horizon and ability to withstand volatility, these 3 positions have survived every crisis and enabled their holders not just to preserve wealth, but to grow it over time. The mechanism behind why these particular positions work is rooted in fundamental economic realities that transcend any particular era or policy regime. Cash represents pure optionality, the ability to act when others cannot. In a crisis, most market participants are forced sellers, either because they are over-leveraged and face margin calls, or because they need liquidity for survival, or simply because fear overwhelms rational calculation. The holder of cash faces none of these pressures and can therefore wait for the moment of maximum fear when assets are being sold at prices that bear no relationship to their fundamental value. This was true for Bernard Baruch in 1932, for Warren Buffett in 2008, for Bill Ackman in 2020. The principle does not change. Gold represents something that cannot be printed, devalued, or inflated away by government policy. Every fiat currency that has ever existed has eventually lost most or all of its value. The dollar has lost over 95% of its purchasing power since the Federal Reserve was created in 1913. This does not mean the dollar will cease to exist, but it does mean that storing wealth purely in currency or in assets denominated in currency carries a risk that compounds over decades. Gold has maintained its purchasing power over centuries and millennia. An ounce of gold in ancient Rome could buy a fine toga and sandals. An ounce of gold today can buy a fine suit and shoes. The products have changed, but the purchasing power has not. When governments respond to crises by creating money, as they inevitably do because it is politically easier than raising taxes or cutting spending, gold reasserts this ancient relationship. The S&P 500 index represents ownership in the productive capacity of the American economy. The 500 companies that compose it are not static. They change over time as new companies rise and old ones fade. But in aggregate, they represent the ability of American capitalism to adapt, to innovate, to generate earnings, and return them to shareholders. Over any 15-year period in the entire history of the index, it has never delivered a negative return including dividends. This does not mean it cannot fall by 50% or more in the short term. It has done so multiple times. But given sufficient time, the earnings power of American enterprise has always reasserted itself. Someone who bought at the peak in 1929 and held through the entire Depression would have been made whole by 1945 and would have seen substantial gains by the 1950s. Someone who bought at the peak in 2000 before the dot-com crash and held through both that crisis and the 2008 financial crisis would have been made whole by 2013 and would have seen their investment more than double by 2020. The key is time and the ability to hold through the inevitable periods of decline without being forced to sell. This brings us back to the present moment and the question of why Warren Buffett holds $325 billion in cash, the largest position he has ever maintained. Buffett does not make predictions about the short-term direction of markets. He has said many times that he has no idea what stocks will do next month or next year. But he does understand value, and he understands that the prices being paid for many assets in recent years have reflected assumptions about the future that may not prove correct. He has also lived through enough cycles to recognize the patterns that precede major dislocations. In 2007, Berkshire held approximately $40 billion in cash, an unusually large amount at the time. The following year brought the worst financial crisis since the Depression. In 2019, Berkshire held $120 billion, again drawing criticism from those who thought he was missing out on market gains. The following year brought the COVID crash. Now he holds $325 billion and has sold half of his Apple stake, his largest holding, and a company he has praised effusively. He is not buying anything despite numerous opportunities. This is not a prediction that a crash is imminent. It is simply pattern recognition. When the most successful investor in history, someone who has navigated every crisis of the past 7 decades, positions himself this defensively, it warrants attention. Central banks buying physical gold at rates not seen in 70 years tells a similar story. These are institutions with access to information and analysis that far exceeds what is available to individual investors. They employ hundreds of economists and analysts. When China increases its gold reserves from 1,000 tons to over 2,000 tons officially, and likely more unreportedly, it is making a statement about what it expects from the international monetary system. When Russia liquidates Treasury securities and converts the proceeds to gold, it is preparing for a world in which dollar-denominated assets may not be as secure as they have been for the past 80 years. When Poland, Turkey, India, and Singapore all quietly accumulate gold despite its lack of yield, they are hedging against outcomes that their models suggest are possible, if not probable. These institutions see the $36 trillion in US government debt, a figure that has doubled in just the past decade. They see the political impossibility of addressing this debt through spending cuts or tax increases on a scale that would make a meaningful difference. They see that every crisis of the past 25 years has been met with monetary expansion, with interest rates cut to zero and money printed in quantities that would have been unimaginable to previous generations. They see that this pattern once established, is difficult to break because the alternative is to allow the deflationary cleansing that would be politically catastrophic, and so they prepare for a future in which the dollar, while still the world's reserve currency, may not maintain its purchasing power in the way it has in the past. Gold at $2,700, a new all-time high reached in 2024, reflects this preparation. It is not a prediction of imminent collapse. It is an insurance policy against possibilities that are not reflected in the prices of most financial assets. The allocation across these three positions should not be dogmatic, but should reflect the realities of one's situation. A young person in their 20s or 30s has time on their side. A 50% market crash, while psychologically difficult, is ultimately an opportunity if they have decades before they need the money. Such a person can allocate heavily to the S&P 500 because they can wait out any decline and will benefit from the long-term compounding of earnings and dividends. They should still maintain cash for optionality and gold as a hedge, but the bulk of their portfolio can be in equities without taking excessive risk because time is the greatest risk mitigator available. Someone in their 40s or 50s is in a transition period. They have accumulated some wealth but may still have decades of life ahead. A severe market crash could derail their retirement plans if it comes at the wrong time. They need more balance, more cash to provide stability and optionality, maintaining the gold hedge against currency debasement, but still enough exposure to equities to benefit from long-term growth. The exact percentages matter less than the principle of diversification across these fundamentally different types of assets. Someone in their 60s or beyond faces a different calculus entirely. They may not have 15 or 20 years to wait out a severe bear market. A 50% decline could mean the difference between a comfortable retirement and having to return to work or depend on others. Such a person needs substantial cash reserves, both for stability and for income. Needs the gold hedge, and can still benefit from equity exposure, but cannot afford to have the majority of their wealth subject to the full volatility of the stock market. What this allocation provides is not a guarantee of riches or a promise of perfect timing. It is something more modest, but more valuable. The ability to survive whatever comes. The next crisis, whenever it arrives, will be different from all that have come before in its specifics. The triggering event may be something that no one is currently anticipating. The asset that suffers the most initial damage may be one that has been considered safe. The path of the crisis and the response from governments and central banks may take forms we have not seen before. But the fundamental dynamics will remain. There will be a moment of panic when those who need liquidity cannot obtain it at any reasonable price. There will be a policy response that involves monetary expansion, because the political costs of deflation are too high for modern democracies to accept. There will be a recovery as the productive capacity of the economy reasserts itself, and human ingenuity finds ways to adapt to new circumstances. Those who position themselves to take advantage of these dynamics, who maintain optionality through cash, protect against debasement through gold, and participate in long-term growth through broad equity exposure, will not only survive, but will be positioned to accumulate wealth as others are forced to liquidate. This is not speculation or market timing. It is pattern recognition applied to a century of financial history. The same three positions that worked in 1929, worked in 1973, worked in 2008, worked in 2020, worked in 2022. They will work in the next crisis as well, whatever form it takes and whenever it arrives. The only question is whether you will have positioned yourself to benefit from this knowledge before the moment when that knowledge becomes desperately necessary and impossibly expensive to obtain.